Let me ask you a question. Let's say you have two different investment opportunities. Project A costs $10,000 and promises to pay you back $15,000 over 3 years. Project B also costs $10,000 but pays you back $16,000 over 5 years. How do you, actually, know which one is the better deal? Just looking at the total profit can be misleading. Why? Because money today is worth more than money tomorrow. You need a way to compare these projects on an apples-to-apples basis. That's where the internal rate of return, or IRR, comes in. It's one of the most powerful tools in finance. And by the end of this video, you'll know exactly what it is, why it matters, and how to use it to make smarter investment decisions. So, what exactly is IRR? In the simplest terms, the IRR is the interest rate that makes the break-even point for an investment. Think of it this way. Every investment has costs. That's the money you pay up front, and it has benefits. That's the cash you get back later. The IRR is the exact discount rate, or interest rate, where the present value of all those future cash benefits perfectly equals the initial cost. To get just a little technical for a second, it's the rate that makes the net present value, or NPV, of a project equal to 0. If that sounds complicated, don't worry. Just remember this. IRR is the project's intrinsic percentage return. It tells you, in a single number, what rate of return that investment is actually generating for you each year. Okay, so why do we even care about this number? Its power is in comparison. First, it gives you a single, simple percentage you can use to rank different projects. If Project A has an IRR of 18% and Project B has an IRR of 14%, you instantly know that Project A is generating a higher return on your money. But the most important use of IRR is comparing it to your hurdle rate. A hurdle rate is just the minimum return you're willing to accept. For a company, this is often their WACC. That's the weighted average cost of capital. For you, as an individual, it might be the 8% you could get from a simple index fund. The decision rule is dead simple. If IRR is greater than your hurdle rate, the project is a go. It's generating more than your minimum acceptable return. If IRR is less than your hurdle rate, the project is a no-go. You'd be better off putting your money elsewhere. It's a powerful yes or no signal for any investment. So, how do you find this magic number? Well, this is where it gets tricky. The formula for IRR is complex. You're essentially trying to solve for R, the IRR, in the net present value formula. Honestly, nobody does this by hand. It's a painful trial and error process. You'd have to guess a rate, say 10%, calculate the NPV, see if it's 0. If not, guess another rate, say 12%, and just keep guessing until you get as close to 0 as possible. It takes forever, and it's a huge headache. Manually calculating all this can be complex. That's why I built a free, easy-to-use calculator on my website, fincalconline.online, to do it for you in seconds. It'll save you a ton of time. I'll put the link in the description. Now, for most people, the easiest way to find IRR is using a spreadsheet, like Excel or Google Sheets. The function is incredibly simple. It's equals IRR values. All you do is list your cash flows in a column. Remember, the initial investment must be a negative number, since it's cash out, and all your returns must be positive numbers, cash in. Then you just type equals IRR and select all those cells. Hit enter, and you've got your internal rate of return. Let's use a real example. Imagine you're buying a small machine for your business. Your initial cost in year 0 is negative $50,000. Your return in year 1 is positive $20,000. Your return in year 2 is positive $25,000. And your return in year 3 is positive $15,000. Is this a good investment? Let's say your hurdle rate, your cost of capital, is 10%. We'd go into our spreadsheet. Cell A1, negative 50,000. Cell A2, 20,000. Cell A3, 25,000. Cell A4, 15,000. In another cell, we type equals IRR. A1, 2. A4, Excel or Google Sheets will instantly give you the answer, 13.5%. Now, we use our decision rule. Our IRR is 13.5%. Our hurdle rate is 10%. Since 13.5% is greater than 10%, this is a good investment. The project is generating a return that beats our minimum target. Now, IRR is fantastic, but you need to be aware of two common pitfalls. Mistake number 1. The NPV versus IRR conflict. Sometimes, you'll have two projects where one has a higher IRR, but the other one has a higher net present value, or NPV. This usually happens when projects are of vastly different sizes. Here's the pro tip. If IRR and NPV give you conflicting answers, always trust NPV. NPV tells you the total dollar value a project will add to your pocket, which is ultimately what you care about most. Mistake number 2. Multiple IRRs. This is a quirky one. If your project has unconventional cash flows, meaning it goes negative, then positive, then negative again. Like a project that has a big cleanup cost at the end, you can actually get multiple IRR answers. It can be very confusing. So the pro tip is, if you have unconventional cash flows, be cautious. It's another reason why financial analysts often rely on NPV as their primary decision tool. But, for 90% of standard investments, an upfront cost, followed by a series of positive returns. IRR is a fast, powerful, and reliable tool. Alright, let's recap the 3 most important things to remember. 1. IRR is your investment's break-even interest rate. It's the intrinsic, percentage per year return that project is generating. 2. The decision rule is simple. If your project's IRR is higher than your hurdle rate, it's a green light. 3. When in doubt, trust NPV. If you get conflicting results or have weird cash flows, NPV is the gold standard for making the final call. So, your action step is this. The next time you're looking at any investment, don't just guess. Take 30 seconds, pop the numbers into the free calculator on my website, fincalconline.online. Link is in the description, and find the IRR. It will give you a clear, data-driven, yes or no answer. If you got value from this video, please hit that like button and subscribe for more in-depth finance guides just like this one. Thanks for watching, and I'll see you in the next one.